So for the last couple of years, PwC has published a full VAT and indirect taxes guide for Africa, which covers generally all the important points that Africa need to know of. But today, we've launched a special edition of the VAT in Africa guide, which covers regulations and rules that non-resident suppliers need to be aware of when supplying electronically supplied services to consumers in Africa. Unfortunately, there's no uniform or harmonized approach to tax and digital economy in Africa. There are different policies in different countries, different rules and regulations and requirements which are associated with registration, compliance, and enforcement. So the first thing that non-resident suppliers need to be aware of when supplying services to consumers in Africa is that the local VAT rules and regulations may not align to international best practices. For example, the majority of the countries around the world have a rule where a supply is made between two businesses across borders, then the person that receives the supply would account for the VAT under the reverse charge mechanism. But the majority of the African countries have enacted rules to tax non-residents in such a way that there's no distinction between services to an individual like me, B2C, or to a business, B2B. And this actually goes against all OECD guidelines. Another point to note is that most countries have very low VAT registration thresholds or even nil VAT registration thresholds. So whilst a non-resident may consider that their sales are not material, what they need to realize is that these rules will be caught in the local countries. Finally, the VAT rules on taxing the digital economy change thick and fast in this part of the world without much lead time or grace period. So all suppliers who provide electronic services to consumers in Africa really need to closely monitor the developments affecting the digital economy in every country that they supply these services to make sure that they remain tax compliant.